Good morning everyone, and welcome to another R of Crypto video. Today's markets have seen a bit of a recovery. The price of Bitcoin yesterday was around 20,900. Today it's gone up by 2%, standing at almost 21,500. The global crypto market cap, which had dipped below $1 trillion yesterday, has also recovered quite a bit above the $1 trillion psychological level, going up by 3%. So now it's standing at $1.03 trillion. Similarly, Ethereum has seen a 4% jump, BNB 3%, Cardano 3%, Solana 4%. So the whole market is up in general, and we see green all over the place in the last 24 hours. It's a good sign. I think that the market overreacted to the Fed's minutes in which they will increase interest rates. Yep, they'll increase interest rates, but it's not the end of the world. I think that the prices dipped more than what they should have due to the sell-off of a lot of people scared of these increases in interest rates having a negative impact on the crypto market. In addition, the effect was compound because when others saw the decrease in price, they also started selling, further putting downwards pressure on the price of Bitcoin and other cryptocurrencies. And that's why the price of the cryptocurrencies went down by more than what they should have, and now they're recovering to the more stable levels. If we look at the Bitcoin charts, we see that since the 19th of August, which is about 4 days ago, the markets have been trading quite laterally. The markets haven't moved much. Ever since the Fed's announcement that they're going to continue increasing interest rates, we saw the price dropping massively from about 23,500 to about 20,000. And since then, it has been trading laterally within a narrow band of maybe $1,200, which isn't much compared to the entire price of Bitcoin. So the prices are now stabilized. It just depends on what the news is and how it will affect the markets. If the news is relatively positive, we could see the price of Bitcoin touching the 22, 23, or even 25,000 levels once again. But if there is still hawkish sentiment in the market or negative sentiments in the market, we might see the prices going down to 20,000, dipping below 20,000, and even maybe going to 18,000, because the negative pressures are still pretty much there. And there is a lot of short positions that are flooding the market at the moment, creating downward pressures to the price. But there are also a lot of bulls in the market keeping the prices afloat, and it's just a tug of war and a waiting game to see where the prices move to. So Ethereum merge drama continues as traders pile out then back in. People are confused about what's happening because there is a lot of money flowing out of Ethereum, then a couple of days later money flows back into Ethereum. So there is quite mixed sentiments on whether the Ethereum merge is going to be good or not. So Ether's steep price plunge on Friday brought a swift decline in open interest on derivatives, contracts that traders use to make leverage bets on the cryptocurrency's future price. But on Monday, money flooded back into the Ethereum's future market once again. And this is quite confusing because usually when money flows out, a lot more money flows out. But at the moment, money is flowing out and then money is flowing in. So it is a matter of understanding that there are those that are removing money from Ethereum and maybe investing it in Bitcoin or investing it in, let's say, stocks and bonds, because maybe they don't believe that the merge is good. But there is a large proportion of Ethereum traders or crypto traders in general that believe that the Ethereum merge will be good, and that's why they flooded money into the Ethereum's future market, hoping that after the merge the prices will spike. However, there are many analysts saying that the merge has already been priced in to the Ethereum price. So Ether perpetual funding rates, talking a little bit about that, when combined with the spike in open interest you observed this morning, it seems these new positions in Ethereum futures are biased long. So remember that in the futures market you have the long position, which is betting that the prices are going to go up, and you have the short position, which is betting that the prices are going to go down. In this case, the Ethereum futures are biased long, which means that in general the future traders are expecting the price of Ethereum to go up, and they're betting that the prices will go up. Investors therefore are bullish at these price levels currently, which means that they expect at $1,611, as you can see up here, at this price level, they expect the prices to increase even further. Also, trading volumes have flipped. Ether's share of weekly combined trading volume of Ether and Bitcoin hit 57%, the highest since 2018. This trading activity exceeded Ethereum's previous peak of 55% during the May 2021 crypto sell-off. And the main driver of Ethereum trading activity in July has been increased optimism around the merge. As we spoke about before, there is a lot of positive sentiment around it. and also an improvement on global risk sentiment. And this is due to the fact that inflation, despite it still being high, is lower than before. The importance given to the Eastern European crisis isn't as much as it was before. We see the oil prices going down, therefore it puts less pressure on the inflation itself and disposable income, which does lead to an increase in consumption, which does lead to an increase in the economic growth rates. Speaking a bit of proof of work Ethereum fork, there's ample speculation that many Ethereum miners might try to keep supporting a proof of work which the blockchain currently uses, similar to Bitcoin's. Ethereum Classic and ETHPOW, based on a new theoretical fork that might take place, have been touted as possible choices as the merge approaches. So a lot of these miners aren't really happy that Ethereum is moving to a proof of stake platform because they've already built such a massive rig. These rigs often contain hardware equipment worth thousands of dollars, and they're not happy that they have to chuck it all away due to the fact that the merge will take place. So what they're doing is that they're trying their best to remain in a proof of work situation, and Ethereum Classic and ETHPOW will help them remain in a proof of work situation, as these two coins are pegged one-to-one to Ethereum. While some Ethereum merge concerns such as further delays, an unsuccessful transition, and proof of work for competitors remain amongst traders, ARCA research analyst Nick Hotz says that most of them are overblown, and they say that there are concerns relating to Ethereum, but most of them are blown way out of proportion. And it's a fact that if the merge is successful, and I believe that it will be successful, then the price of Ethereum will explode, and the adoption of Ethereum in mainstream application creation, and also to be used as a currency due to the fact that it will be more faster, more secure, and more robust, will also increase. Once Ethereum reaches a specific total terminal difficulty or amount of computing power dedicated to the network, the merge is going to happen. So expect this merge to happen within 3 weeks or on the 15th of September. And exciting times ahead. Let's see how the markets react. On other news, the IMF calls for regulation amid increased co-movement of crypto and equities market in Asia. So the IMF has said that the co-movement of cryptocurrency and equities market in Asia, especially in India, Thailand, and Vietnam, calls for urgent regulation. The IMF has observed that retail and institutional investors in these 3 countries are among the top adopters of the crypto market. And it is high time for the financial regulators to step in and integrate the crypto and financial markets. Also, the Global Financial Institution, or the IMF, noted that the return correlation of Bitcoin and the stock market in India have increased tenfold since the epidemic, indicating that crypto offers modest risk diversification benefits. So we have come to a point where even the IMF is asking for countries to speed up their regulation on crypto, and they're saying that crypto and stocks are becoming widely correlated, and if there is regulation in place, at least this correlation can break somewhat and can offer a asset class that can be a diversification tool in institutional or individual portfolio. It is further observed that the digitalization of money will create an eco-friendly payment system and would accelerate the financial inclusion of people who cannot afford to use traditional banks. So a lot of people in third world countries, especially in sub-Saharan Africa, cannot afford to have a bank account. But at the same time, most of them have a cell phone. If they have a cell phone, especially a smartphone, it means that they can afford to download a free wallet and can use Bitcoin, Ethereum, or any other cryptocurrency or any stablecoin as a means of payments. So we can have a whole informal market, for example, let's say the selling of clothes and food, clients and vendors both trading in crypto extremely quickly, very low fees, and extremely convenient because all you need is a cell phone. So as cryptocurrency acceptance grows, the government agencies in Asia worry about the risk it poses. Consequently, they have increased their focus on regulation, and regulatory frameworks are being developed in various countries including India, Vietnam, and Thailand. And India is one of the countries that is heavily focusing on regulation, but they're not doing it correctly. What's happening is that they levied a 30% tax plus surcharges and cess on capital gains obtained from crypto assets, which is the highest tax bracket. If they want crypto to become adopted by their population and become mainstream, a 30% tax is not the way to go. And I believe that there can be a massive overhaul in the Indian crypto tax regimen, and this will lead to mass adoption, because a country of over 1.3 billion people has a lot of potential for the adoption of crypto and for it to go mainstream. So the financial sector appears to be immune to abrupt fluctuation in the price of crypto, but this may not be the case in future market cycles. Retail or institutional investors who both own crypto and traditional finance assets may get affected. Large crypto losses may cause these investors to rearrange their holdings, potentially generating financial market volatility or even default on traditional liabilities, which could cause a contagion effect since the whole world's financial markets are connected. And financial market volatility or default on traditional liabilities in one part of the world can be spilled over to the rest of the world, and that can cause another global crisis. So in order to prevent this, the IMF is suggesting regulation so that crypto can be traded fairly and in a systematic manner. So the Skybridge Capital CEO Anthony Scaramucci says Bitcoin won't hedge inflation until it hits 1 billion wallets. In its earlier years, some touted Bitcoin is a potential hedge against inflation given its fixed supply of 21 million coins. The narrative since then has changed, as Bitcoin has been observed as being increasingly correlated to the stock market. So if you have Bitcoin, which is thought to be an inflation hedge, being correlated to the stock market or increasingly correlated to the stock market, this means that its hedge potential is decreasing, because holding Bitcoin or holding stock would be the same thing because they're so highly correlated. So in order to prevent this and in order to break the cycle, Anthony Scaramucci is saying that 1 billion wallets are needed to diversify the Bitcoin that there is in the market so that it is not as correlated to the stock market as it is now. So Scaramucci is still bullish on Bitcoin and overall crypto market, pointing to recent moves from BlackRock to launch a new private spot Bitcoin trust with Coinbase as its custodian, a sign that there is still strong institutionalized demand for Bitcoin. But he offers a warning. Markets are currently filled with a ton of short positions, which could result in people getting their faces ripped off when they least expect it. So there's a lot to be careful of. The market is flooded with short positions because the short traders believe that the price is going to go down, but there are also a number of long positions in the market balancing it out. Hopefully that ratio remains 50-50 and doesn't veer towards the shorts, or else we might see the price of Bitcoin tumble quite quickly. So Memecoins, SHIB, Dogecoin shed double digits over the week. Dogecoin enjoyed a hefty surge last week following the launch of Doge Chain, an independent blockchain built using Polygon Edge, a custom blockchain creation tool from Polygon. So Doge Chain brings EVM compatibility to the Dogecoin network, allowing developers to create apps akin to working on Ethereum. However, Doge's price plummeted 12.4% in 1 week when Jens Wickers, the legal and governance president of the Dogecoin Foundation, said that Doge Chain was not affiliated with Dogecoin. So a big part of the rally was due to Doge Chain, and after Doge Chain was said not to be affiliated with Dogecoin, all of these gains were wiped out. Also, SHIB follows Dogecoin decline. SHIB rallied alongside Doge amid excitement around the expected launch of a layer 2 scaling product named Shibarium. The product is yet to be launched, and because there's been so many delays and due to the general crypto slump itself, the price of SHIB, similar to Doge, went down over the past week. And with that, we come to the end of today's video. Thank you very much for watching. If you enjoyed the video, please leave a like, hit the subscribe button, and share this video with your family and friends. Invest wisely, and cheers.